You know what keeps me up at night? Not the stock market, not inflation numbers, not even the deficit. What keeps me up at night is knowing that millions of ordinary Americans are about to get hit by something they never saw coming, and the people who should be warning them are too busy talking about the next iPhone release or whatever Elon tweeted this morning. So let me be the one to tell you straight. A single meeting between the United Arab Emirates and the U.S. Treasury has cracked the foundation of the entire dollar system, and the chain reaction from that one meeting is already raising your mortgage rate, already draining your retirement portfolio, and already forcing central banks around the world to dump American dollars at a pace we haven't seen in over a decade. I have spent decades studying how markets actually work, not how financial television says they work. And I'm telling you right now, with complete conviction, that what is unfolding in the U.S. bond market is the most consequential financial shift of the last 30 years. And you need to understand it today, not next month, not when it shows up on the front page of the Wall Street Journal. Today. Now, before we go any further, if you are not subscribed to this channel, stop what you are doing and hit that button right now. I mean it. The analysis I do here, the kind that connects a military conflict in the Middle East to the interest rate on your car loan, is the kind of work that hedge funds pay analysts six-figure salaries to produce. I put it here for free every single week because I genuinely believe that financial literacy is the great equalizer. One bad investment decision made in ignorance will cost you more than a year of your working life. Subscribing costs you 30 seconds. Do the math. I want to take you back to 1974. Because here's the thing about financial crises. They almost never start where people think they start. They start somewhere quiet, somewhere most people aren't looking, in a deal or decision or an arrangement that seemed perfectly reasonable at the time. And the arrangement I'm about to describe to you is the single most important financial deal ever made in the 20th century. And I would bet serious money that nobody ever taught it to you in school. The year is 1974. The United States is in rough shape. The dollar had just been cut off from gold 3 years earlier when Nixon closed the gold window in 1971, and nobody was entirely sure what American paper money was really worth anymore. On top of that, OPEC had just punished the U.S. with an oil embargo for supporting Israel in the Yom Kippur War, and the American economy was reeling. Gas lines stretched around entire city blocks. Inflation was vicious. The post-war economic confidence that Americans had taken for granted was genuinely shaken. Into that mess walked Henry Kissinger, and he flew to Riyadh, and he sat down with the Saudi royal family. And he made a deal. The deal was breathtaking in its simplicity. Saudi Arabia would agree to price all of its oil exclusively in U.S. dollars. Every barrel, every transaction, every contract, dollars only, in exchange. The United States would guarantee Saudi security with its military umbrella. The rest of OPEC followed. And just like that, the dollar had a new foundation. Not gold, but oil. And that was actually a smarter foundation than gold, because while you can mine more gold, you cannot easily replace oil. And every single economy on earth needs it to function. Now think about what this means for the dollar, because this is where it gets genuinely brilliant as a financial architecture. If you are in Japan and you need to buy oil, you need dollars. If you are Germany, India, South Korea, Brazil, Turkey, you need oil, therefore you need dollars, therefore you must perpetually hold dollar reserves. Every nation on earth became a permanent, structural buyer of American currency, not because they loved America, not because they trusted American fiscal policy, but because the alternative was not being able to keep your economy running. That perpetual global demand for dollars is what allowed the United States to run deficits that would have destroyed any other currency on earth. It is the reason America can borrow $39 trillion and still have world's reserve currency. It is the entire game, and it has been running uninterrupted for 50 years. I remember when I first really understood the elegance of this system, I sat with it for a while because it was simultaneously one of the most brilliant arrangements I had ever encountered, and one of the most fragile, because here's the thing about a system built on trust and habit and geopolitical arrangements rather than hard assets. It works magnificently right up until the moment it doesn't. And the moment it stops working, it can unravel with a speed that leaves most people completely blindsided. That moment, I believe, is now beginning. Let me tell you exactly what happened in that Treasury meeting, because the details matter enormously, and most of the financial media has either missed the significance entirely or is deliberately soft-pedaling it because the full implications are genuinely uncomfortable. The United Arab Emirates requested a meeting with Treasury Secretary Scott Bessent. Now, I need you to understand who the UAE is before you process what they asked for, because context is everything here. The UAE is not a developing nation coming to Washington for foreign aid. This is a country sitting on $270 billion in foreign exchange reserves. The Abu Dhabi Investment Authority alone manages somewhere between $700 billion and $1 trillion in assets. These are people who fly in private jets to meetings about other private jets. They do not typically show up in Washington asking for help. So when the UAE walked into the U.S. Treasury and asked for a currency swap line, essentially a dollar lifeline, a direct pipeline to American currency, that was a 5-alarm signal about how serious the situation in the Gulf has become. Here's the underlying problem. Since the U.S. military engagement with Iran escalated at the end of February, the Strait of Hormuz has been effectively strangled. Now, if you want to understand why this strait matters so much, consider that approximately 20% of the entire world's daily oil supply passes through a channel that is roughly 21 miles wide at its narrowest point. 20% of global oil through 21 miles of water. The UAE has been hit by nearly 3,000 missiles and drones. Their oil export infrastructure is operating at a fraction of normal capacity. And because the Gulf states earn their dollars by selling oil, a shutdown Strait of Hormuz means a shutdown dollar revenue stream. Kuwait, which is a significant oil exporter, exported 0 barrels in a single recent month. 0. The last time that happened was 1991, when Saddam Hussein invaded and burned the oil fields. So the UAE comes to Washington and says, we need dollar liquidity because we are not generating dollars the way we normally do. And then, according to reports that came out of this meeting, the UAE raised the possibility of pricing some oil transactions in Chinese yuan. I want you to sit with that for a moment, because I have been watching markets for a very long time, and I can tell you that sentence is one of the most significant things said in a financial context in the last 50 years. It is the equivalent of walking up to the load-bearing wall of a building and saying, nice wall, be a shame if it came down. Washington understood the threat immediately. And then the Treasury confirmed publicly that it wasn't just the UAE. Multiple Gulf and Asian allies had made the same request. Not one country quietly asks a favor. Multiple countries simultaneously signaling that the petrodollar arrangement is under genuine stress for the first time since Kissinger put it together. Washington provided the lifeline. The United States blinked, and the moment that happened, the first domino fell. Now let me walk you through the chain reaction, because this is where it gets personal. This is where a geopolitical event on the other side of the world becomes the interest rate on your mortgage, the value of your retirement account, and the price you pay for everything. I have always believed that the best investors are the ones who can trace a chain of consequences all the way from its origin to its end point in their own portfolio. So follow me through this carefully. The Strait of Hormuz is disrupted, and Gulf oil exporters suddenly have their primary revenue stream cut off. They need cash to fund their governments, their militaries, their social programs. Where do wealthy nations park their cash reserves during good times? In U.S. Treasury bonds, because for 8 decades, Treasuries have been the most liquid, most trusted asset on the planet. Japan holds over $1 trillion of them. China holds around $750 billion. The Gulf states hold hundreds of billions more. So when these countries need dollars urgently, what do they sell? They sell the most liquid dollar-denominated asset they own, which is U.S. Treasury bonds. Now, simultaneously, the oil-importing nations, Japan, India, South Korea, Thailand, Turkey, are facing higher energy bills because the supply disruption has pushed oil prices up, and they need more dollars than usual to pay those bills. So they, too, are selling treasuries to raise dollars. You now have sellers on both sides of the oil trade liquidating U.S. government debt at the same time, and the volume is staggering. In the last 30 days, roughly $240 billion of U.S. government debt has been dumped by foreign central banks. Japan, which is the single largest foreign holder of U.S. debt, sold $47 billion in 1 month. China has cut its treasury holdings to the lowest level since 2008, an 18-year low. Foreign central bank dollar holdings at the New York Federal Reserve are sitting at the lowest level since 2012. These are not small numbers. These are historic numbers. Now here's the relationship I want you to permanently wire into your brain, because it will serve you for the rest of your investing life. Bond prices and bond yields move in opposite directions, always, without any exception whatsoever. When everyone is selling treasury bonds, the price of those bonds falls. When the price falls, the yield, the effective interest rate, rises. Think of it this way. If a bond costs $1,000 and pays $50 a year in interest, the yield is 5%. If that bond's price drops to $800 because of mass selling, but it still pays $50 a year, the yield is now 6.25%. The payment didn't change. The price changed, and the yield moved inversely. That is happening across the entire treasury market right now. And the treasury market is the benchmark from which virtually Every other interest rate in the American economy is derived: your mortgage rate, your car loan, your student loan refinancing, your business line of credit, corporate bond rates, commercial real estate financing. They all move with a 10-year Treasury yield. When the 10-year goes up, everything goes up. And right now, the 10-year is sitting at 5.2% and climbing, with Bank of America's survey of global fund managers indicating a consensus expectation of 6%. The last time the 10-year yield was at 6% was 1999. I remember that period very clearly. The economy felt unstoppable. Tech stocks were going vertical. Everyone was a genius. And then 2000 arrived, and then 2001. And the NASDAQ lost 78% of its value. And a lot of people who thought they had built something durable discovered that they had just been riding a tide of cheap money. And that tide is now going in the opposite direction. Mortgage rates are already at 6.3%. That half percentage point increase that has already happened adds roughly $200 to the monthly payment on an average mortgage, which is roughly $64,000 in additional interest over the life of that loan. That is real money coming out of real families, and it is happening right now as a direct consequence of what started with that meeting in the Treasury building. Let me give you the numbers that I think about when I wake up at 3 in the morning, because there are a few data points in this story that are genuinely historic and deserve to be treated with the gravity they carry. Central banks globally now hold more of their reserves in gold than in U.S. Treasury debt. That is the first time that has been true in over 35 years. Let me restate that plainly, because I want it to land properly. The people whose entire professional existence is devoted to managing national wealth, people with teams of PhD economists and access to every piece of financial intelligence on the planet, have collectively and independently decided that they trust gold more than they trust U.S. government paper. That is not an investment preference. That is a verdict on the trajectory of dollar credibility. And they just set an all-time record for gold purchases in a single quarter. Not the biggest quarter in a decade, not the biggest since the financial crisis, but the single largest quarter of central bank gold buying in recorded history. Goldman Sachs has a price target of $6,300 an ounce on gold for this year. JP Morgan is in the same neighborhood. These institutions are not gold enthusiasts or doom and gloom newsletter writers. They are the most sophisticated financial operations on earth, and they're telling you in plain language where the smart money is moving. The dollar, meanwhile, is down approximately 8% since late 2025 on a trade-weighted basis. And both Goldman and JP Morgan see another 10% decline as a likely outcome. If you are sitting in dollar-denominated savings earning 5% in a treasury while the dollar itself loses 10% of its purchasing power, you have just lost money in real terms while technically collecting interest. That is the trap that tens of millions of Americans are sitting in right now inside their retirement accounts, and most of them will not realize it until the damage is already done. And then there is the debt service problem, which is the part of the story that I find most troubling of all because there is no clean solution to it. The U.S. government is now paying over $1 trillion a year just in interest on its existing debt. That is more than the entire annual defense budget. It is nearly 20 cents out of every single tax dollar collected, just in interest. $3 billion a day flowing out of the Treasury to bondholders before a single dollar is spent on roads, hospitals, schools, or anything else. And if the 10-year yield reaches 6%, that interest burden grows further, which means the government must borrow more, which means more bond supply into a market with more sellers than buyers, which pushes yields higher, which increases the interest burden further. That is a spiral. And the honest truth is that there are only a few ways out of a debt spiral of this magnitude, and none of them are painless for ordinary people. The government can inflate the debt away, which destroys the real value of your savings and your salary. It can borrow more and keep kicking the can, which is what has been happening for 20 years. Or it can cut spending dramatically, which in a democracy where every voter wants their benefits protected is essentially impossible to do at the scale required. So they will do some combination of the first two, and the cost will be paid by everyone who holds dollars, which is everyone reading this right now. Now, I have always believed that understanding a problem without knowing what to do about it is just productive anxiety, and I have never had much patience for productive anxiety. So let me give you the framework for thinking about where to position yourself, because the same environment that destroys some assets creates extraordinary opportunities in others, and the job of a serious investor is to be on the right side of that equation. What gets destroyed in this environment is everything that was built on the assumption of perpetually cheap money and a perpetually strong dollar. High-growth technology companies with no current earnings are the most obvious casualty. And here's why. The way analysts price these companies involves taking their projected future earnings and discounting them back to the present using the prevailing interest rate. When that discount rate doubles from 2 to 4% or triples from 2 to 6%, the present value of $1 of earnings in 2030 or 2035 collapses. A company that looked cheap at 40 times earnings when the 10-year was at 1.5% looks grotesquely expensive at 40 times earnings when the 10-year is at 5.2%. That is pure mathematics, not sentiment, and it explains why so many high multiple tech names have gotten absolutely punished even as their underlying businesses continue to grow. Real estate investment trusts face a structurally similar problem because their entire model depends on borrowing cheaply to buy assets that generate income, and when borrowing costs spike, the math stops working. Small-cap companies with heavy debt loads see their refinancing costs explode in ways that can turn a marginally profitable business into a cash-burning disaster, and long-duration treasury bonds, the kind that sit quietly in target date. Retirement funds and balanced portfolios lose market value as yields rise, meaning the supposedly safe part of your retirement account is actively working against you in this environment. On the other side of that ledger, the picture is genuinely interesting if you are willing to go where the evidence points rather than where the comfortable narrative leads. Energy companies benefit from exactly the kind of supply disruption and dollar weakness we are experiencing. Because oil and gas prices rise in real terms when the dollar weakens and geopolitical tension restricts supply, their earnings are real, present-day cash flows, not projections about what might happen in 2032. Gold miners carry operational leverage that makes them compelling in a rising gold environment. Because when the gold price goes up 30%, a miner with fixed operating costs might see its profit margin go up 60 or 80%. Banks benefit in a rising rate environment because the spread between what they charge borrowers and what they pay depositors widens. And that spread is the core of their business. Commodities broadly benefit because dollar weakness makes commodities cheaper for foreign buyers, which stimulates demand. Hard assets, real, tangible things that cannot be printed into existence, are where serious money goes when confidence in paper money is eroding. And I would argue that confidence in paper money is eroding right now in a way that is both measurable and accelerating. The evidence for this is not hiding. It is sitting in the central bank gold purchase data. It is sitting in the Treasury yield numbers. It is sitting in the dollar index chart. The investors who are going to look back on this period and feel good about their decisions are the ones who looked at that evidence clearly and acted on it before it became the conventional wisdom. The conventional wisdom is always late. I want to close with something personal because I think it matters. I have watched a lot of financial cycles over a long career, and the thing that has always struck me most is not how complicated markets are. It is how simple the core truth almost always is, and how few people are willing to act on a simple truth when acting on it requires doing something that feels uncomfortable or contrarian. The simple truth right now is this. The petrodollar system that has underpinned American financial dominance for 50 years is under the most serious stress it has ever faced. The bond market, which is a mother of all markets, is pricing in a reality that the stock market has not yet fully digested. And the investors who understand that chain of causation, from the Strait of Hormuz to the Treasury building to your mortgage statement, are going to be positioned correctly when the rest of the market catches up. You have two choices right now. You can close this video and assume that someone smarter than you is managing the situation and that it will all work out the way it always seems to work out. And maybe you will be right. Maybe this time the Fed will find a magic lever and the dollar will stabilize and the debt will somehow become manageable and the bond market will calm down. Maybe. Or you can look at the data I just gave you. Look at the historic nature of what central banks are doing with their reserves. Look at where the 10-year yield is heading and make some deliberate decisions about your portfolio based on evidence rather than hope. I know which choice serious investors make. I know which choice I made decades ago when I realized that markets reward the people who do their homework and act on it, and they punish without mercy the people who knew the truth and did nothing with it. The first domino has fallen. The chain is already in motion. And what you do in the next few weeks will determine which side of that motion you end up on. Do the work, make the calls, and if this video gave you something genuinely useful, pass it on to someone whose financial future you care about, because this is exactly the kind of information that the people around you need right now and are almost certainly not getting anywhere else.